be starting a well, I'm starting on time today, despite the wonderful, wonderful, wonderful world of get things going a little bit early. So hopefully everything is working a-okay here. It looks like we're still streaming, sending data as are getting started. I do not see any of our loyal subscribers yet online, but let's get things started for the 11/6 edition of Skeptic Sunday. So in today's stream, one of the things that I really want to focus in on, it's going to be joys of the Q3 Berkshire Hathaway earnings call. There's been a lot of things happening here. It's been a pretty, how shall you say, a pretty mixed bag in the past quarter with stock earnings. For those of you unfamiliar with Berkshire Hathaway is the really the investment group of famed investor Warren Buffett. Warren Buffett's known as the Oracle of Omaha and is one of the successful investors of the earliest 21st and 20th centuries, and is also known as one of the richest men in the world. So what Berkshire Hathaway has done is it's predominantly insurance companies. They own a lot of famous brands such as Geico, Duracell, among others. And what that allows them to do is they leverage the cash flow of these companies in order to actually be able to buy up shares in different companies. So let's get started with just a quick view. I am just checking on where one of the ever loyal subscribers is. And we will continue in a second here. So just in terms of this, let's just pull over here. I am not on my actual video. Nice, 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 nice. I added a new video source. So there we go. Here I am. Beautiful. So Berkshire Hathaway is still earning at an incredibly strong clip. It's one of those things where it is doing extremely well for itself, but there have been a number of things that are impairing Berkshire's actual earnings. I'll pull up the earnings report in a minute to actually be able to go over that with you guys in a little bit more detail. But as always, Berkshire is doing well. They're sitting on $105 billion worth of cash. So really, they're not doing too badly in the grand scheme of things. Let's be honest with ourselves. It's pretty good to be Warren Buffett at the moment, as they're enjoying a really strong cash positive in here. So it's one of those things where for the Q3 earnings, we've seen a couple different things here that I think are important. One of which is going to be, and again, this is for informational purposes only, guys. If we go over here to the Q3 earnings, what has happened with Berkshire Hathaway is, there's been a really big insurance underwriting loss at 962 million. So there have been a number of different losses this year for Berkshire Hathaway. Probably, let me just go back here for a second. So just in terms of Berkshire Hathaway has two ways of earning money as an organization. So you've got the actual companies that Berkshire owns, which produce most of its cash flow. But at the end of the day, Berkshire Hathaway's core business is that it's an insurance provider. So it can suffer a great deal of insurance losses on the companies that it actually owns and covers. So this produces a lot of problems, especially in a time period like 2020, 2022, where we've seen really catastrophic losses in places like Florida due to hurricane season. So you're looking at about $1 billion in nearly $1 billion in insurance losses. So the third quarter is never kind to our friends at Berkshire Hathaway, but if you look at its revenue, predominantly the company has always made a lot of its money through insurance investment income. So that stands at $1.4 billion. So it does make up an extremely sizable portion of the company's revenue base. With that being said, Berkshire is not, in the first 9 months of this year, they have not earned an underwriting profit on their insurance offerings. So this is one of those things where, having worked at an insurance company and being based out of Hartford, Connecticut, I think it's really important to understand the ways insurance companies actually make money. So insurance companies, a lot of people think, oh, the insurance company is gonna, try to screw me over because, they don't want to pay out claims. Well, that's not how an insurance company makes money. An insurance company makes money off of something called the fluke, which is the amount of money they have invested at any given time. So if they're able to earn more in investments, let's say if that's fixed income investing or something of that nature, the insurance company actually will get what is called, where most of its profits come from. So as you look here, really Berkshire Hathaway's claims business is really, it doesn't really look that attractive because they have lost $962 million this year just on their insurance claims alone. But in a year with premiums, there's two ways you can make money here. So generally, if you're able to invest the money, as long as you have funds in excess of your reserve requirements or what your actuaries tell you need to pay claims, you're in a wonderful position. You are really in a wonderful position because every dollar you get in excess of your reserves is just profit onto your bottom line, and it really allows you to expand your capital very quickly. So this is one of the reasons why Berkshire Hathaway has made so much money, is their ability to profit off of the insurance float or owning these insurance companies, and it produces an incredibly strong bottom line profit for Berkshire. But key to the company's strategy, and this is one of the things where insurance really has afforded Buffett the leverage and the reserves he needs in order to make extremely large company purchases. And it's one of the reasons, Warren Buffett, we could argue he's the Oracle of Omaha. He's this great investor. Honestly, there's two places that are known for insurance these days. It's Hartford, Connecticut, and Omaha, Nebraska. You wouldn't really think of that, but it's one of those things where, from an investing perspective, the insurance itself is really, it's not super sexy. It's not super obvious, but that cash flow position or the cash flow created by the insurance float is what allowed Berkshire to be able to buy out other companies, because they're essentially using their cash reserves or capital looking at the market value of undervalued companies such as, when they purchased Geico, when they purchased, I believe it's either Gen Re or Munich Re that is now a constituent element of Berkshire Hathaway. But what this enables you to do is you get a really freaking amazing deal, and you're able to leverage those premium dollars by essentially writing insurance. So insurance is effectively a beautiful, beautiful, beautiful business when done correctly. It becomes really interesting because you're always able to really hold on to those premium dollars. And when you're calculating out the float, you can make money on the float, and you can always make an underwriting profit, which is your adjusted earnings. So most, I just want to go back over to this earnings statement really quickly and just actually buff this up a bit. That way we're visible here. I'm going to actually just pop myself off the screen so it's easier to see what on earth I'm talking about. So with Berkshire itself, the way that this company is making money, it's actually really, really not sexy. It is incredibly boring. So you can see the railroad profit at 1.42 billion for operating earnings. So in terms of actual, losses, this was a brutal quarter where we've seen nearly $10 billion. You've seen nearly $10.5 billion in write-downs just from Q3 related to the value of Berkshire Hathaway's actual stock portfolio. Does that really impact the company given how much cash it has? Yes, to a certain extent. Are those really fully realized losses? Sometimes, not necessarily. But when you're looking at the company's actual third quarter operating earnings or operating revenues, the insurance investment income is still more than enough for Berkshire in most years to cover and earn a small marginal profit from insurance investment income. This is really, really, really cool because what it allows them to do is essentially they can sock that money into utilities and energy and into the different constituent businesses that Berkshire Hathaway controls, and you are just earning so much cash from this. I mean, it is this is really just incredible when you're looking at the position, cash is king here. So these insurance-based businesses really have allowed Berkshire to make some incredible purchases. But this is kind of deceptive where it's like, oh, Berkshire Hathaway has lost $10 billion. So honestly, Berkshire losses itself are not really all that important. So when you start to think about, how the company is actually performing, this $10 billion investment loss is incredibly off-putting. It's like, it's really gotta just drive you absolutely crazy. But the reason why Berkshire Hathaway has managed to be successful is really focused on buying assets with cash and doing a very good job, at least in its earlier days, at insurance underwriting. So they're buying assets that end up producing a dividend that really end up allowing them to cover the float here. So effectively, this business is it's a highly leveraged business in a lot of ways. People like Dave Ramsey, are like, oh, no debt, no debt, no debt. Debt is always, this really terrible thing. Debt is, debt's really bad. But when you're looking at the actual businesses themselves, each one of these businesses within the Berkshire Hathaway portfolio is able to operate as leverage for, for the insurance company itself. So now there's a lot of ways that this could be set up, in order to reduce leverage. There's a lot of things like reinsurance that go on here. It is possible to lose an arm and a leg in insurance. For those of you not familiar with the insurance business, a lot of companies on the Lloyd's exchange really, they can be utterly ruined because they don't have, they don't really have a diversified insurance business, or they don't really own other businesses that produce enough cash flow to really, to really offset a lot of their insurance losses. So insurance is a relatively great cash cow that can be used to fund expansionary activities and can be used to fund, the continued growth and expansion of a business past a certain size. But it's really not a great standalone, it's really not a great standalone business. And this is really where, you see a lot of Warren Buffett's success through finances, where he has been incredibly successful. Also, hello, Twitch fan. If you want to follow us here on Nomadic Insights for the Nomadic Insights Skeptic Sunday talk show, where we go through different earnings and investment success. You'll have a good time. Hello there, Mr. Twitch person, sir. We see you in the stream. So this is one of those things where, this is why I consider insurance to be a really great business model, because it effectively allows you to accumulate more and more cash. And as you gradually improve your equity in the cash, you really begin to, build up your equity and improve your cash flow position. Now, with all of those things in mind, and with those things being said, there's a lot of inherent risks to what Berkshire Hathaway has done to a certain extent. It makes this business model really difficult for, let's just say, normal people to implement. Like actually buying an insurance company, it is not something that a lot of people, have the wherewithal or stomach for. This is an incredibly boring and stodgy business. Insurance is not known for being that really, it's just not known for being an exciting business. I light up as I talk about insurance because I think insurance can really produce a lot of, it can produce a lot of long-term advantages. It can produce a lot of, positive cash flow benefits. So this is one of those things where you're seeing investment companies move into the insurance business. So, hedge funds have been buying up life insurance companies, for example, or other life insurers. And what this allows the life insurance companies to do is you can you have a very large source of capital, and capital is very predictable. It's one of those things where the insurance business, you can look at claims being, pretty unpredictable with some of these catastrophic losses. But life insurance is not, it's not really that unpredictable. Neither is something, for example, sometimes like travel insurance. These things are just not super unpredictable. So what that allows you to do is you're able to actually predict very clearly what your earnings are going to be over the long term. But again, you have two ways of taking profits here. You have insurance underwriting profit, and then you have insurance related investment income. So in a year where Buffett has done extremely well, these investment winnings are enough to cover insurance underwriting costs or losses from insurance underwriting. So it is one of those things where reserves are very difficult to calculate. There is a lot of fancy math that goes into this, but it is definitely, it's definitely one of those things where I also can't tell if something really exciting just came up, but it's one of those things where a lot of the actual investments that you're going to see are pretty easy. It's pretty easy to actually come by and actually makes it's actually, I want to say it's easier to make some money, but this is really where you get a lot of value. It's just understanding that it's this underwriting profit, and there's ways to get this underwriting profit using margin and leverage. But really, this is how Buffett's businesses were really successful. And I've been meaning to do an episode on Buffett for a while. I might finally just do that for my long form video, with Charles, Charles Munger as well, with value investing. But this idea of buying these really valuable companies, well, gee, I'd love to buy really valuable companies, but you need to find a way to buy the companies profitably. And you're looking for things like effective management. There's a lot of different things you're starting to look for. But from a profit perspective, what the insurance business, or really this boring cash cow, really allowed Berkshire to do was it's really allowed them to expand into other businesses to the point where, I mean, if you're looking at it from a revenue perspective, this looks like a real boring conglomerate at 1.4 billion here, in insurance and investment income. So I mean, you'd be looking at a $500 million profit on these operating earnings. But again, a lot of the profit, from Berkshire comes from the balance sheet. I mean, I really do pull that up. Q3. Yeah, it's just one of those things. That is very low tech looking. Free by Berkshire Hathaway. Apparently, oh, this is okay. Interesting. Technology and creative services. Nice. Interesting. Okay, so apparently, as we're looking at the earnings, they really want to sell us their insurance products, don't we? So you can tell how Berkshire makes its money here. Um, that is one of the worst websites I have ever been on. Maybe as Luddite as I expect. Oh my god. This has to be one of. Okay, these guys do not like technology. Lovely. So, this is very ridiculous. I mean, this is actually startling how bad the Berkshire Hathaway website is. My tech guy is just going crazy here. Holy crud! Holy crud! This is like no frills, no nothing. Wow! Just wow! Oh, man. Just wow! This is not. That is not good. Okay. Um. Now, I mean, I've never actually heard of Forsymes, so that is an interesting. That is an interesting little pick. But let's just continue here at Berkshire Hathaway. I mean, it's like you can see stylistically just how different though Berkshire Hathaway is. I mean, this is insurance, man. This is insurance. It is boring. It is stodgy, and just nobody really cares. That is pretty much insurance 101. Hence why I'm reacting to Berkshire's website. I thought they would have at least updated it as we kind of start going into this a little bit more. So let's get it in my head. So consolidated. So again, if we're looking at most of the assets ending in the period of Q3. Okay. Uh, So, as you can see, I mean, with a $13 billion loss, ooh, mamma mia. And that's one of the other, that's one of the other things that makes Berkshire Hathaway a bit unique is the dual tier. It's really the dual tier structure on stocks. They're a really unique company. When you think about it, it really is just kind of crazy. Luddite perspective they really take here. But I mean, it's like when you're looking at the comprehensive actual loss, you're looking at, $2 billion full annualized loss from Berkshire Hathaway here, which, you know, the grand scheme of things doesn't appear to be that bad into the company's actual, in relation to the company's actual earnings, considering they've got like about $100 billion. So the company is still sitting on a great deal of cash and other assets. So it's one of those things where they still continue to have large positions inside of companies such as Kraft Heinz. There's a monopoly on these really basic goods and products outside of the core insurance business that really give Berkshire Hathaway a really, really large shield in the market, which is what I want to say here. It's definitely one of those things where Berkshire historically has had, it has confronted a lot of difficulty with, just with accessing different, different products and different things. But let's continue for a little bit here with what I mean by, what is going on with Berkshire Hathaway. So let us continue. So I do want to very quickly. Okay. So that's the other thing that I think it's kind of important to note here is just the investment style of. Let me just pull this up really quickly.
EV maker. So can you tell us more about that?
So many years ago, BYD, Berkshire bought a pretty significant stake in BYD by 20%. They've held on for about 10 years, and they started selling little slivers of it starting late this summer. This is the third sale they've done. Another 3 million shares here. They sold about a million and a half also in September. So they still own over 200 million shares. So it's still like a significant, kind of holding. But the question is Warren ready to kind of exit this? They made a lot of money off this stake. They bought it for 225 million, I think, 10 years ago, and now it's over 10 years ago, and now it's worth, 7 billion, I think.
So this is one of those things where, if you're looking at the China market at a macro level, a lot of things here going on with this BYD stock exit that it seems like these guys kind of want to get into. And realistically speaking, it just really seems like a lot of a lot of what is happening with Berkshire, a lot of what is happening with, in even this case, the earnings period, is that Warren Buffett is reconsolidating, and the writing is really on the wall. In the case of the Chinese market, I don't think that's a particularly surprising finding, that when it comes to China, it really seems like the writing is on the wall. It seems like things are not going to be going well. So, with that in mind, it doesn't really make sense with BYD to holding on. And I just want to make sure. It's electric automotive maker. Now, this is one of the things where it's like, with BYD, it keeps saying it's an electric car maker. So BYD is actually interesting, and it's not really a stock I've done a lot of coverage on EV makers. Hey, this is kind of a boring company. But the BYD Han looks like very almost equivalent to like a Tesla. I mean, where it looks a little bit better. This is actually pretty high tech. Warren Buffett. Okay, interesting though. Does not look like we are. Okay, so we've got BYD Electronics. We're into more. This is boring. Okay, so I mean, it's just like, for Warren Buffett to be fully invested in the next generation of things here, that's what I find so curious, is this idea that Warren Buffett is going to be investing in an EV company. That seems like a bit of a stretch to me. Looking at the actual Chinese automakers, BYD's move on April 3rd, 2022, they completely phased out combustion engine cars. Yeah, there we go. So it's trying to be leading edge. It's trying to be on the next generation of electrical powered vehicles, and this begins to make a lot more sense. So if you look at, I just want to go back here for a second. If we actually go back on to the Berkshire Hathaway website, this is going to give you a very good idea of how Berkshire Hathaway actually makes investing decisions. This is probably one of the world's, most boring website, and it is one of the world's most boring websites. And it does not appear to have been updated in the last 20 years. This is what websites looked at like in 1995. I mean, this might have even been a good website in like 1995. Back when I was crawling around on the ground. It looks really, really interesting for sure, but it's definitely, it definitely makes life a little bit interesting. So now let us continue here. Now, again, it's just like with this BYD exit, if they're trying to be like the next generation, next big company, this is why Warren Buffett would actually exit from that. Ooh. Now, this is one of those other things that I've seen a lot of where it is like Google stock is screamingly cheap. Google is not cheap necessarily, as there's a bit of an online ads apocalypse. So this is one of the things where I would recommend a little bit I would recommend a little bit of caution. It really doesn't make a lot of sense to assume that there is a great deal of market demand or market, or even market push here within the market, for Google stock when everybody else is just, doesn't really seem to be doing particularly well within the market at the moment. But now let us continue.
Let's get a bigger view on what's going on in technology now and continue the conversation on the tech space and this morning's earnings with Independent Solutions Wealth Management Portfolio Manager Paul Meeks. Paul, good morning. It's good.
I actually expected them to get dinged by the macro, because one of the things that you have to remember, particularly with the social media oriented companies, their digital advertising models, and even if they have big slices of market share in that space, the pie is shrinking. And so when you take a look at Meta and Alphabet, I thought Alphabet, given the fact that it's not going through a wrenching business model change like Meta is, would be more resilient.
So that's the thing where Meta is not going through a wrenching business model change. Meta is just going through its very own kind of, stupid, its very own stupid business model change. It just doesn't really make a whole lot of sense when you actually start to think about the business model itself. It just seems like Meta is going through all of this, for lack of a better term here, really, really stupid, self-inflicted pain. What's up, Twitch viewers? It's nice to see you. How you guys doing? So Google, while it is changing its business model, a lot of changes to the business model, they just seem really, really dumb in what Meta is doing, and I've been harping on that now for the past couple of weeks as we've gone through the stream, as we started talking about things more and more and more. It's like, why are you doing that? Just why? It makes no sense what they're doing over at Meta. But let's just continue here.
But Rand, the results that even Alphabet reported last night did chill me a little bit.
Paul, you said in your notes to us that you're only investing in the dogs with the fewest fleas out there. So what do you mean by that, especially right now, given some of the macro headwinds that companies have continued to cite, especially within tech, over the course of this earnings period?
Yeah, so what I mean by that is...
Okay, so you should only invest with dogs with the fewest fleas. Well, generally speaking, you shouldn't be investing in dogs with fleas. Anyway, hello! What a shock there. What a shock. So personally, I don't recommend you ever actually invest in any dogs with any fleas. I just think that is a good it's just a good point of view to have to begin with. But again, that, this doesn't make a great deal of sense to just say, hey, I'm gonna, get the dog with fewer fleas. I don't get that. I seriously don't get this. Like, I'm so sorry. What a terrible idea. So right now the world is on fire with tech. So any ad heavy business model right now is kind of screwed. So when you're looking at businesses that are fighting inflationary pressure, like let's take a good look at something you would think would be pretty, price resilient, would be somebody like Stryker Mako, who's really, really getting killed right now, where they're not able as a med tech company to make a lot of these investments because of inflationary pressure. And where do you think they're going to be pulling funding from? I mean, really, that's just the thing that really kills me with people, is it almost seems like they're not thinking these things through. It just doesn't really make a lot of sense to me, where, why would you think that this is the next generation of investing? Why? This doesn't really make a lot of sense, but let's continue. No fees approach.
So I'm best known to be a tech investor. People don't hire me to invest in Procter & Gamble. But of course, I'm not naive enough to know that my sector could be out of favor, and it could be out of favor for long stretches, and we're actually in one of those stretches. So I don't want to force feed anything. So my portfolios, I have very large cash, and I've been that way since Thanksgiving of last year.
Okay.
And when I say that dogs are the fewest fleas, I don't want to sound like I'm being cavalier, but I'm looking for companies that can actually grow their revenue and earnings despite a recession.
So this is one of those things where it's not just the dogs with the fewest fleas would be the ones who are in like the strongest monopoly position, like Google with search, like Microsoft with productivity apps. So, I don't really know if that's like the dogs that have the fewest fleas, if it's really grounded in speculative investing. This is one of those things where it's like, I'm really, really inclined to take this, take pretty much everything with a grain of salt. And what I mean by this is it just doesn't make a lot of sense to be going, hey, let's invest with dogs with the fewest fleas, because everybody's looking for safety. And the market is just really going, yeah, dogs with fewest fleas, like, come here. Okay, bye. Come here. He has no fleas. Apparently, he's a good investment. Oh, yes, they said dogs with the fewest fleas. You look so sad, buddy. I'll miss a dog. So that's just definitely one of those things where, sorry, I couldn't resist this with the dog here. But this idea that, I'm Mr. Tech Investor. Yes, I am. I'm so high tech. It's really obvious that you should be investing in the highest possible margin of safety you can find. I don't really think that is a controversial position. And yes, that was just a Spanish water dog, and he does not have any fleas. So you should be investing in Spanish water dogs, folks. In the middle of this. Oh, hello, Mrs. Key Cat. Yeah, sometimes the wildlife does come on the live streams. There's not a lot we can do. Hello, hello. Are you the credit cat? Are you about investing, Mrs. Key Cat? Yes, yes, we are. Oh, okay. You have the worst timing in the world, silly, silly. Oh, she's got terrible timing. Okay. Now let's continue here.
When they report said numbers,
Here comes
they
the
are
tail.
beating the numbers, and they still have maybe not great valuations, but reasonable valuations. And quite often, these are companies that are much smaller cap than the FANGs, that are under the radar, that I find at least some semblance of value.
Paul, you mentioned that the Alphabet report gave you chills. What do you need to be ultimately seeing over the next couple quarters to become unchilly? When do we see things getting better for Alphabet?
Yeah. I don't think that we can actually say with any confidence, I need to invest with confidence, that we have seen the last downgrade in quarterly revenue and earnings per share estimates for that company. And so, regardless of the fact that it's, in some measures, at least according to its history, it's screamingly cheap.
Yeah, that's definitely one of the things with these stocks where the actual earning downgrades really do, for lack of a better term, really become quite worrying as revenue has continued and continued to decline. Yeah. So I silly little cat. Um, um, I never thought we would see this day, would we? Where we're seeing a so my actual keyboard is not the one that matters. It's the keyboard that lets me go to do my stream changes, and apparently cats love to be on top of that. Go fit. But I guess that's just me. So with Google itself, the core advertising business is really, really going to take it. It's really going to be hammered. There's a lot going on with the individual stock itself, but it doesn't make a lot of sense to continue putting your money right now. Um, you know, Really from a yield perspective, you're doing something that's more, revenue generating, just kind of taking this like dollar cost averaging approach to life, where you're just putting money in the market consistently in order to generate a consistent profit, where you're just going to keep, really, if you're just a long-term investor with dollar cost averaging, that's where the market begins to make a bit more sense, where it's like, oh, the 2 years are over, oh, the bad times are over, everything's going to be fine. Because realistically, we've been heading for a correction for a while. I think that goes without, yes, hello, kitty cat. Yes. Oh, silly, silly. As you can see, the cat is getting head rubbing. Very excited. Wildlife. Yes. So she sporadically and just head rubbing. Yeah. It's the smiling, uh, flashing tail and stuff. But it really just does not make a lot of sense to continue investing in tech companies at the moment. We are in a you really want to be on the lookout for counter cyclical companies or businesses that are not really cyclical in nature. A lot of the spending that was able to last during the recession was really because the tech sector was pretty much hello, yeah, yes, hello.
We cannot rally, or we cannot rally consistently until we get the bottom in the numbers. And I don't know if that's the next quarter. I don't know if that's the next quarter after that. So what I need to see is a bottom in the estimates, no more downgrades, and maybe, even if the company continues to report bad news, maybe a rally despite the bad news. Those would be two very good tells, not just to get back into Alphabet, but the other large cap tech names.
So I don't really think over short term we're going to be seeing, I just don't really get the sense that we're going to see this rally in tech that he seems to be looking for. It's one of those things where, in terms of, yeah, who wants our head? Oh, silly. Oh, hello, good girl. It's just one of those things where it doesn't really seem to begin to make a lot of sense to continue pushing for it. But we'll see. We'll see what ends up happening. So that should be pretty interesting, and we'll see what begins to take place over the next few months with this. Whether or not we get into a rally like situation, who knows? But we'll see what happens here.
Paul, you've been through other tech cycles, right? How does this compare, do you think? How's it going to compare? And are we going to see fallout where we're going to see some companies go away, or maybe some of the smaller players get snapped up?
I actually think that some of the tech companies, or tech-ish companies, or tech-related companies that essentially were brought to the dance only because they were COVID plays may not have another growth leg post-COVID.
That's one of the other big things here was, when you're looking at the real economy for a lot of these companies, like let's take a play like Zoom, like Peloton, or something like that. These were COVID growth plays. These companies were only ever going to do well. I have to go somewhere at 11. Got this little tiny cat who just so desperately wants to be my bestest buddy. And, they were only ever going to do well within the context of COVID. There wasn't a future growth leg for most companies. So a lot of the, let's take Netflix. I mean, when everybody was at home with nothing better to do than watch videos, that are for Activision Blizzard, when people were only home to ever play video games, that created a lot of potential positive and benefits for these companies. But otherwise, it just really does not seem like there's been a lot of positive forward growth. But hey, we'll see. We shall see, guys. We shall truthfully see as we continue forward. So, guys, thanks so much for joining Nomadic Insights here for a little bit of a short Skeptic Sunday. I really appreciate everybody who came out this morning, and we hope you stay awesome. Thanks so much, guys. It's like we're living through kind of these pseudo bubbles where obviously all the companies that were remote and favored remote work did well temporarily. I just do not see what is super, super hard to understand about that. I really just don't get why that is so bizarre, so difficult to understand. Well, guys, thanks so much, and I really hope you have an awesome rest of your day, and hopefully you enjoyed Skeptic Sunday and a little bit about insurance this morning. Thanks, guys.